What's going on, you guys? My name is Zach Hartley, and Palantir has just released their Q2 earnings. And I currently have a position in Palantir, so what I want to do in this video is show you my position, evaluate the financials, and update our financial ratios so that we can try to understand how cheap or expensive is Palantir right now. Here is everything you need to know. Let's go. Okay, so like I said, I do have a position in Palantir, and today on the release of their earnings, we had a dramatic movement. So as you can see, this is the volume indicator down here in the green and red bars. And as you can see, we have about 2 or 3 times as much volume today as we have had over the last basically couple of weeks here. And as you can see, that has caused the price to dramatically increase. As I took this screenshot, it was up 10.69%, and it has kind of broken through this little period of consolidation that we've been in here through the last few weeks. Now, I currently have a position in Palantir, and I actually bought the options, and the options moved pretty dramatically today. As you can see, they were up 84.37%, up to a high of $2.40 when I took this screenshot, and my position was up about 69% at the time. I do think it has dropped a little bit since I am filming this video. However, we are doing extremely well on this options trade. I'm pretty happy with the results so far, and if you're interested in seeing the trades that I make and when I enter and exit these positions, then you can definitely check out my Discord chat. You can see that I posted this trade right here on July 28th. I talked about when I was buying in, what price I'm looking at, and where I'm planning to take profit. So if you want to see any of that information, definitely check out my Discord chat. There's a link down below in the description to this video where you can sign up. It's $5 per month. You can ask me anything you want. There's a community of investors, and you get to see all of my trades and analysis. Now, let's dive into Palantir and how well they did in this most recent quarter that just happened. So these are the Q2 2021 highlights, and as you can see, the top line here is revenue, and their revenue grew by 49% year over year to $376 million. Their top line revenue grew by 49% in this quarter, which is very, very amazing and very nice to see. You can also see that US commercial revenue, so selling their services to US companies, that revenue grew by 90% year over year, and they closed 62 deals of $1 million or more, of which 21 of those deals are worth $10 million or more. So these are massive deals, and they are working with the largest companies in the world as well as the US government. So they have a lot going on there. As you can see, they kind of go through the different specs here. 20 net new customers added in Q2 2021. Total customers up 13% quarter over quarter. Commercial customer count increased 32% quarter over quarter. Cash flow from operations of $23 million. Adjusted free cash flow from operations of $50 million, representing a 13% margin. GAAP net loss per share of 0.07 and diluted 0.04. So they did lose money this quarter. So let's dive into that in 1 minute, but let's first start with the balance sheet. I always like to start with the balance sheet when we look at a company, because the balance sheet gives you the story and they give you the information of how the company got to where they are. If the company's doing $1 billion in sales, but they have $5 billion in debt, well, that's kind of a big deal, and that's something you want to know about. But if they're doing $1 billion in sales and they only have $5 million in debt, that is a very, very different story. And by looking at the balance sheet first, you can start to understand how the company got to where they are. So that's what we're looking for here. And one of the main factors that you're looking for is assets compared to liabilities. So as you can see, they have $2.3 billion in cash and cash equivalents. These numbers are in thousands. And then they also have a variety of different property, plant, and equipment. They've got restricted cash, they've got accounts receivable, and they've got a variety of different other things that make up a total assets of $3 billion. Now, when you compare that to their total liabilities, just a real quick comparison, it's about $1 billion. So that gives them a total debt to total asset ratio of 3, which is very nice and very healthy. You're basically looking for anything above 1.5 would be considered safe. So to see 3 is a very good sign. When you look at their current assets to current liabilities, these are the cash that they have that's accessible within 12 months, as well as the debts that are due within 12 months. That's an even better ratio because their total current assets is $2.6 billion and their total current liabilities is only $680 million. And so that gives them a current ratio of roughly 4x, which means they have 4 times as many current assets as they do current liabilities. And that is very healthy, that is very clean, that is very safe. And it shows that this balance sheet in this company so far has been managed very well, or at least they're not running the risk at all of running out of cash. Now, one thing that I do want to point out here is on the liability liability side, their actual largest liability here of $257 million here, this is actually customer deposits. So this is customers that have either paid up front or given them some type of prepayment or given them a deposit in order to get the future services. And so this is just cash that is probably just sitting in their bank account or sitting in a holding account right now. And so when I look at this, you can almost subtract that and it makes all the numbers better. So when I look at the balance sheet here, I go, wow, this is a really healthy company. They don't have any risk right now. And as long as they're not burning through cash like crazy, they should do extremely well. Now, when you look at the income statement here, it's a little bit more complicated because there's a little bit more going on. So top line revenue, $375 million in the 3 months ended June 30th. Compared to last year where it was 251, that represents an increase of 49%, which is very, very impressive. The company is growing at a rate of 49% year over year. You don't see that very much, and you definitely don't see that very much in a company of this size. And so very, very impressive. Next thing I want to point out to you is the gross profit margin. How much are they making on that revenue that they're bringing in before they have to pay all of their operating expenses and taxes? That number is about 75% or $284 million. And that is extremely high. That is a very good profit margin, gross profit margin. And that is very nice to see because it means that for every dollar they're bringing in, they have 75 cents that can go towards their expenses and towards shareholder pockets. And that is much higher than most other industries and almost every other company. So very, very impressive. I really like to see that. And that entire top section of this income statement is very good and very nice to see. Excellent growth, excellent margins. You can't really say anything bad about these first top lines here. Now, when you get down to the operating expenses, this represents everything that the company is spending to operate and run the company that isn't associated with a sale. And one of their largest fees here is sales and marketing. So they are really getting out there and they're really trying to sell this product and they're spending a lot of money to do that. Now, I do expect the ratio of sales and marketing compared to revenue to come down over time because this literally represents almost 40% right now. And that would be tough to kind of scale up. But I do think over time, more and more people are going to understand Palantir. They're going to know about Palantir and the sales and marketing number should come down. And then you also have research and development at $110 million. This has drastically gone up since last year, which is to be expected. This is definitely a growth company right now that needs to be investing in R&D. So I fully understand this number. I think this is definitely reasonable because it sounds like they're really trying to push the boundaries and come out with new products and go into new markets. So that seems reasonable to me. And then general and admin rate here, this has gone up pretty significantly from 93 to 157. That's more than a 50% increase, and the revenue hasn't gone up by 50%. It's gone up by 49%. So I would like to see this cut back a little bit and definitely brought down as a proportion of revenue. But as of right now, it's a small red flag. It's not a big red flag. It's not a great sign, though. They're definitely spending a lot of money here. You can see they're spending $430 million in operating expenses. So as of right now, their operating expenses are actually higher than the revenue that they're bringing in, which is not a good sign. It is not sustainable. It's definitely a red flag here. And it's something to keep an eye on is, are these ratios of these operating expenses compared to the revenue, are those ratios coming down over time? As of right now, it doesn't look like it, but they are in that growth mode. So it's going to be a matter of time and it's going to take a little while to tell that. But as of right now, they're growing at 49%, which is extremely, extremely impressive. Now that we have these income statements in the balance sheet, what we want to do here is compare some of the ratios to try and understand, is Palantir a good deal at this level now that we understand a little bit more about the company? So the first ratio here that I want to look at is price to sales. Now, regularly, if the company was profitable, I'd like to use price to earnings because that gives you a much better idea of the company. But unfortunately, this is a growth company that is spending a lot of money for that growth and they are not profitable. So you can't use the regular price to earnings ratio that Warren Buffett likes to use and that a lot of investors, including myself, like to use. And so for me, the next best thing is price to sales. What I'd like to see is how much am I paying for this company compared to how much money are they bringing in? And then you can use that ratio to compare it across the industry or to different companies. And so for Palantir, I'm just going to do simple math here, really nice and easy. So as of right now, they brought in $375 million in the last quarter. There's 4 quarters in a year. That gives them $1.5 billion in revenue for if you basically extend this out for a year. So that's the number that I'm going to use. If you look at their market cap right now on Yahoo Finance, it's about $46.6 billion. At least it was when I took a screenshot. And when you divide 46.6 divided by 1.5, you get 31. And so that gives them a price to sales ratio of 31. And honestly, that is fairly high. It's definitely not a great sign, but it is sort of in the ballpark of what I was expecting. And so basically what this is saying is that the price of Palantir compared to the sales that they are bringing in is a ratio of 31x, or the price is 31 times higher than the yearly sales at this current rate. And honestly, that is a fairly high ratio. That is definitely not a great ratio. And when you compare it to some other companies, it's not a great sign. It's definitely a little bit on the expensive side, but most of the other companies you can compare this to also aren't growing at 49%. So you need to keep that in mind. Now, the next ratio that I like to use and that a lot of people like to use is price to free cash flow. And the reason that I like to use price to free cash flow is because this can kind of take into account the growth that the company is going through. So for instance, if they're profitable, but they're reinvesting that money back into plant and equipment and things like that, well, in that case, this ratio will take that into effect. And in Palantir's case, it's kind of nice because they're currently generating about $50 million in free cash flow per quarter. So we can extend that out to the year. That would give them $200 million in free cash flow per year. And at a market cap, the same one we used in the last equation of 46.6 billion divided by 200 million, that would give us a price to free cash flow of 233. And again, that is fairly high and fairly expensive. And that's not a great ratio, or that's not something that you would look at and say, hey, that's cheap right now. But again, Palantir is growing at a fairly fast rate. And so when you look at the growth rate and you actually dive into it, this is where it gets really interesting, because quarter over quarter from last year, 49% growth. Strangely enough, it was the exact same thing when you look at the 6-month over 6-month time period. Again, 49%. And when you look at the year over year growth, it's 47%. So it's actually slightly increasing over time, which is definitely a good sign to see. It's very, very impressive. And it's actually quite surprising how quickly they're growing right now. So I'm very impressed by that. And then I think the best part about this company, or at least the best feature for me, is the profit margins, currently at 75% gross profit margin right now, which is just absolutely amazing in my mind. That gives the company a whole lot of flexibility as long as they can continue to increase that top line revenue, because in theory, that general and admin expense should not increase at the same rate as revenue. Hopefully the sales and marketing gets more efficient so it doesn't increase at the same rate as the revenue, and hopefully all of the other factors kind of follow suit with that. And in that case, the company would be closer and closer to profitability, especially with the 75% gross profit. So very nice to see. The other thing that's nice about this company is that they have very long-term and steady contracts. They're working with governments, they're working with major corporations that are integrating this software into their operations, and that's not something that they do on a short-term basis. So that's very nice to see. I think the cash flow for this company should be fairly easy to forecast, and this company is increasing those forecasts, and then on top of that, it's growing very quickly, which is just a fantastic business model to be in. And they're also acquiring more and more customers at what seems like an accelerated rate based on those highlights that I read to you earlier. So here are my final thoughts. I know I've kind of given you some mixed signals here of this is really good and this is really bad. And honestly, that's just the reality of this company. It's actually a really impressive company with a great business model, fantastic margins, and great growth. But it's also fairly expensive right now, especially when you look at some of those ratios. And so my final thoughts are that, number one, this is probably going to be a pretty important and pretty large company 10 years from now. So if you're a 10-year, 15-year investor, I think it's probably a safe bet that Palantir is probably going to be here in 10 or 15 years from now, and they're probably going to be much more important and much more valuable than they are today. So if you're a long-term investor, Palantir is probably a good place to park your money. If you're a short-term investor, though, I do think Palantir is fairly expensive at these levels, but I also think it has huge potential, especially with what it is doing, the business it is in, the software business model that they have, and the potential of that software. I think there's huge potential here. And so me personally, I plan to swing trade it. I'm going to be getting in and out of it. I think it's going to be fairly volatile. I think it's going to be fairly news-based. But as of right now, the earnings seem to be the big momentum makers here in the stock chart. So I'm going to be trading the earnings. I'm going to be trading in and out of the swings. I'm probably going to take a small position to just hold long-term and put in the portfolio and forget about. But as of right now, for a short-term trader, it's a little expensive. If you're long-term, 10, 15 years, you're probably going to do just fine, but expect some volatility. Now, if you're interested in learning a little bit more about how to understand the stock chart, read the financials, and evaluate a company like this, then definitely consider signing up for my Stock Market Fundamentals course. It is completely free and it's hosted on Skillshare, where you can sign up and get access to the entire platform for 2 weeks completely free. You can take my course. It's 9 hours long and there's over 7,000 students that have already gone through the course. There's over 300 reviews for you to take a read through, and I promise you it'll be the best free resource that you can find online when it comes to learning about the stock market. I walk you through the step-by-step, everything you need to know to either fundamental invest or technical trade. Everything is there for you and it's completely free, and the link is in the description to this video. Now, just as a disclaimer, this is my opinion. This is not a sponsored video. This is literally me just explaining my position and how I feel about these earnings. So if you get any value out of that, remember to click that like and subscribe button, and I'll see you guys in the next video. Good luck trading, good luck investing, and we'll talk to you soon.